Hello and welcome to the Relax It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. Hi, Josh.
Hi, Wendy. How are you today?
I am good. Now, who do we have with us?
Today, we have Pete Belcastro, CFP, from our team on today to talk about some predictions and kind of recap some of the market activity from last year. So welcome, Pete.
Thanks. Great to be back. Hi, Wendy.
Hello, and thank you for joining us.
Absolutely.
All right, Josh. So, what are we going to be talking about?
Well, we're going to talk exclusively about frogmen today. Frogmen were men predicted to, and possibly women, I guess, as well, that were to live in undersea bunkers and tend to kelp farms. So in 1966, rather, the Rand Corporation had made this prediction that with potential food shortages and the increasing need for a larger food supply, that kelp could be one of our primary food staples. And that we would have these frogmen, or it would be an occupation to live underwater and help grow kelp in underwater kelp farms.
For people to eat, not fish.
For people to eat, that's correct. Yeah.
Oh, you know what this reminds me of a little bit? Like the Lion King when he has to start eating the grubs.
Okay, yeah.
Yet satisfying or
That's
squishy.
Like when the evil uncle takes over and it becomes you're saying when he's with Timon and Pumbaa and they're eating bugs.
I would say you have kids. You have to know the
Oh
line.
yeah. I'm pretty well. I could sing if you need me to. As well.
Please do.
No, we'll save that for another.
Oh,
We got to keep it short today.
Oh.
it sounds about it just as appetizing, though.
Yeah. But I know Pete, for you listeners, I know that Pete is a huge fan of Brussels sprouts. So this kelp probably falls in that same category, right, Pete?
I feel punished every time I have to look at them,
But the thought from the Rand Corporation was that kelp was a rich in protein plant that was sort of easy to grow. So this would be a great way to help increase the food supply. One of their other predictions in the same article had that spouses would be able to secretly control one another's moods with grouch pills. So that hasn't happened. Now, granted, we do have, I guess like Adderall, Prozac, some other drugs that have come onto the market that maybe help overall with moods, but maybe a glass of wine, but we had that back in 1966 as well. But these predictions are pretty amusing to think about today. But when we look into the future, we always try to draw some sort of assumptions or think that a trend is going to take things one way or the other. But I think what history has repeatedly taught us is that, well, that's not always true. I think another one that I pulled up from Irving Fisher in 1929. He was quoted in October of 1929. Keep in mind, this is a Yale economist, so presumably way smarter than I am. He predicted that stock prices may have reached a permanently high plateau. 3 days later, the stock market crashed, which was the beginning of the Great Depression. Needless to say, stocks neither permanently plateaued or permanently fell. In fact, they've trended up over the long term since then, believe it or not. And but that's not to say that there weren't cycles along the way. So sometimes having this grandiose prediction is not the most direct way to go. I think when we look back even over the last year, if we look at the top analyst predictions, 23 of the top analyst predictions for 2023, they had an average price target on the S&P 500 of about 4,080. The S&P actually ended 17% higher at almost 4,800. So, even some of the highest paid analysts or the smartest people in the room, so to speak, are not able to accurately predict the future. I think Pete has spent a lot of time digesting the market and analyst reports over, the last year. So he has a little bit more data than just that one high level number for us. So Pete, I'll turn it over to you here. What were some of the factors that were predicted or assumed to happen last year that didn't quite flesh out the same?
Absolutely. Yeah, there was definitely a few things. I mean, I don't think anything, nothing too shocking like we're changing how our diets are, like eating kelp or anything. I mean, my wife does make me eat those kale chips every once in a while, so that might be close. So we might be not too far away from the frogmen here. But last year, I think everybody saw how 2022 end. Hey, the market was down about geez, over 18%. There's certain indicators that economists were looking at, like you said, a bunch of people crunching all these numbers, and the probability of a recession. A lot of people don't know, but there's charts about just about every part of our economy, and you put together these ideas, and the probability of a recession last year. There's a whole index around this. There's a 44% chance of recession. To kind of put that in perspective, before the 2000 downturn, the probability of a recession was just over 25%. So people thought that the sky was going to fall. I don't know if did you feel that way, Josh, at the beginning of the year there?
I'm sort of an eternal optimist, so I always try to say, hey, there's good things going on, and 2022. Now, granted, I have hindsight bias now. 2022 was a particularly bad year, which means that it's quite easy to make positive growth from there.
You got it. Yeah, but the numbers were saying that, hey, we probably shouldn't expect that. So why didn't that recession happen? Why didn't the things go down? Why wasn't there a reset? There's a few different factors. Obviously, the one being that the economy was actually adding jobs. So we know that there's a big piece of the puzzle that, if anybody heard about interest rates or the Fed, a lot of those numbers come from, the jobs report. So every month of last year, more jobs were added to the economy. So there was 2.5 million jobs that were added over 2023, which is a huge number. And that just capped off a 36 straight month of employment gain. So people were still hiring, even though they were saying that there was a recession coming. When people were working, you can't really have a recession. There was actually inflation. We all know that, good or bad, inflation was a real thing. We didn't see it for a while, but we actually saw inflation pull back for 9 consecutive months. So from pretty much June to May, we saw from June 2022 to May 23, we saw inflation starting to pull back and starting to normalize, starting to level out. So whenever you take that full step back and say, hey, when did the market bottom? It was actually in October of 22 to the end of last year. The market return for that point is 31% return. So
I'll take it, Pete. Make it happen every year.
Big. Okay? That's it. That's it. So once you start looking at those numbers, you're like, wow, it must have been a pretty easy year. It must have been pretty good. So some of the challenges that happened last year, they're actually, we know about a few things as far as, wars either starting or continuing last year. But one thing that did happen is there were a few bank failures. There's sometimes, bank failures every year, little banks that we don't hear about. But there were 3 big ones last year. So we had a Signature Bank, Silicon Valley Bank, First Republic Bank. Those were 3 bank failures that happened last year. And they're actually the 3 of the largest per dollar amount. I'll give you the largest one here, Josh and Wendy. The largest one was Washington Mutual in 2008. And that was $307 billion. I don't know if you can wrap your head around that, but
oh, I got that in the bank.
It got that, yeah.
Well, good for you, Wendy.
In 2008, yeah, that was huge. So before last year, the next largest bank failure was 40 billion. Okay, so you got 300 billion, you got 40 billion. So why am I bringing this up? Because last year, out of the three, the lowest amount was $118 billion was the assets on the bank that failed.
Yeah,
So,
so that's like
over
a
twice as much,
yeah,
as
almost three
you,
times as big. Yeah.
you got it. The next up, Silicon Valley Bank, 209 billion. First Republic capped out at 229 billion. So pretty much 3 out of the 4 largest bank failures happened last year. So that's something that a lot of us don't, we really weren't aware that they were that large. We saw when they first happened, but none of those people lost their deposits. The system moved in, the assets were, divvied up, but nobody really felt that. It wasn't a big scare like it was, during the Great Depression, let's just say, back in the 30s.
And how does that affect the economy and people typically? Like, how has it affected them in the past as compared to this past year?
Yeah, so
That's
I think one of the pieces that sort of propped things up quite quickly is the government came in quickly and said that they are covering deposits. And we have, if you go to the bank, right? Hopefully your bank has a little FDIC plaque postered all over the place, right? So there are limits that they'll guarantee up to. Well, those were exceeded for depositors, I think, in particularly for Silicon Valley Bank, which really helped reassure the system. Now, I know from our advisor role, we certainly heard a lot of concern from clients because even if your money's backed up, it's quite an inconvenience to switch a bank, for one, or for two, if you have all your bills auto drafted and all of a sudden the bank's gone, you might not be paying your bills on time. So that being said, there's an inconvenience, but in terms of the economy or collapsing the economy, the FDIC did its job, right? The government backstops came in and helped support. Now, still, while we were going through those, I think you could meet with a lot of people and say, oh my gosh, the risk of bank failure, this is going to tear down the whole economy. Now that we look back over time, well, we got through that pretty quickly overall. And I think that that's, really one of the most amazing things. As Pete said, these are 3 out of the 4 biggest bank failures ever. And we had a positive year in the stock market.
I'm just curious, does that mean that the US government paid that money to the depositors? Or is that the insurance?
Well, it's technically the insurance. So part of FDIC, and Pete, maybe you even have a little bit more knowledge in regards to how the the insurance takes the claim. How that insurance is set up, I would assume, is based off of all the member banks are paying so much towards it over time. Is that a correct assumption, Pete?
That's right. Certain amount of deposits, that are kept. And I think that when you start looking at these banks, whenever they do, fail or go down, what happens is they are usually taken over by another bank as well. So another institution steps up, they work out things with the government, but the other bank job really is to secure those assets, that were guaranteed. So there's lots of ins and outs, and geez, I mean, you can go into it forever there, but like Josh said, the bottom line is it does work, and they were able to extend that insurance above the 250 per account title there.
Which I think moving forward brings an interesting piece in. Are people going to assume that that's always going to be the case? I would say don't follow that assumption. What I have seen is now there are some banks that are partnering with other banks to help you exceed that limit. So on some banks' websites or other financial institutions, you'll see guaranteed up to $1 million or maybe $2 million. And what they're doing is they're sharing that with another bank. So while you might have one bank account, they're actually saying, okay, well, 250,000 of this account is actually backed up by this other bank. So they're kind of sharing in that insurance there. That's a new thing that's kind of come about with these more recent bank failures. We'll see. I would say being prudent. If you have more than $250,000 in a bank account, let's try to split it up so that it is fully insured by the FDIC.
Yeah. Yeah, there is like we talked about, nobody lost their money there, but there is a factor that you probably don't want to leave in somebody else's hand, and that is the time frame. You don't want to be sitting there waiting and waiting and not knowing whenever you're going to get your funds. So but yeah, so like we said, it's something that wasn't on our, it didn't affect the market very well, very much, because it was taken care of. And it wasn't something that was on a lot of people's talking points at the end of the year, for that matter, you know. So, and I think another big takeaway is that we had the big seven stocks from last year that really took and ran them with the market, and they're in the tech sector. So we're talking about Apple and Meta, Microsoft, Amazon, Google, Tesla, and that Nvidia. I'm sure people were talking about that, mid last year. So those seven stocks actually made up about 98% of the total returns of the year there. The other company, the other 493 companies in the S&P, they were still up, but, obviously not as great as those seven there. So
So
we had,
Pete, what I'm hearing is that we should just invest all of our money into Apple, Meta, Microsoft, Amazon, Google, Tesla, and Nvidia, correct?
yeah. Gosh, if you could go backwards, just in the past year, that would probably make sense, but
But they're the top companies.
that's right. That's
Uh,
right.
and I am joking a bit, but this is something that happens, right? We have its recency bias where we say, hey, these companies have done great. Let's only buy those. I think more practically, if you look at this, you can say, well, hey, I can get a more even return by investing and diversifying. We can weight a little heavier in certain companies that we think might do really, really well. But, Netflix is one that we've seen get cut in half multiple years.
Yep.
So unless you're prepared for your whole retirement savings to cut it in half, don't invest that way.
What are the
You,
chances, though, that Apple and Amazon are going to go down significantly at this point? I mean, I can understand why Netflix would go down, but really, Apple and Amazon?
But have you heard of a company called General Electric, Wendy? Or Enron, perhaps?
I
These
have.
were also darlings of the stock market at one point, right?
Wait,
You know, we don't know, right? We can predict, Wendy, but there's no guarantees.
Gotcha. And IBM, that's another one.
IBM too, yeah.
that's it.
All right, guys. Sorry.
No, they're definitely, yeah. I mean, looking back there, it does seem like there was a lot of, upside potential there, but you are pretty much pigeonholing yourself in a few positions that, yeah, a lot of, that's a big change to stomach, because before that return, um, you know, uh, those positions, they were down to over 50%. So we try and keep that in perspective, that even though last year we saw some great returns, whenever, in 2002, those overall positions were down over 50%, about 40, yeah, 47, almost 50% there. So
Yeah, and I think, Pete, from our perspective, that is a hard thing often to coach clients through, right? They want to invest in all these companies, they get a good return, and then a year like 2022 into 2023, they're down about 50% in those stocks. Then they don't want to hold them, they sell them off, buy something more conservative, and then those stocks take off, right? And it's like, oh, well, why did I do that, right? So we need to be able to curb the investor behavior there as well.
you got it. You got it. So,
Yep. So, looking forward, Pete, we know everything for the next year, right? And
yeah.
that's what we're going to share on this podcast. We know exactly what you should know. Of course we don't. When we look at the top analyst predictions for 2024, the average is somewhere around 4,832 on the S&P 500, or the predictions that it's going to stay pretty flat. There's some investment groups like Oppenheimer who are targeting, about 9% growth, or the S&P going to about 5,200. And some are more pessimistic, like JP Morgan Chase, who's predicting about a 12% loss on the S&P for the year. or a price target of 4,200. So those are kind of all over the map there. And that's
Yeah.
looking at 14 different, sort of high profile companies that spend an awful lot of money to try to predict this. And well, -12 to +9 is a pretty big range for me. So, we'll take it all with a grain of salt. But I think, what we're seeing there, the trend is, well, the assumption's that it's pretty flat. Now, keep in mind, last year, they were off by about 17%.
That's right. That's right. Yeah, it's whenever you start looking at these analysis and you got one that says, hey, it's going to be up, you got one that says it's going to be down, you got one that says it's not going to change, as investors, what do we do?
Yeah. Yeah. And I think, Pete, there's a lot of factors. I think a big one that we're going to hear a lot, we've already heard some grumblings, is the presidential election, right?
You got it. Big year here at the US.
Yeah. I mean, I think certainly all political affiliations aside, there's going to be a lot of volatility socially around that. What tends to happen is we have, one party think they have the solution to everything, and the other party thinks the other one's evil, and it goes back and forth perpetually. I think, Pete, you had pulled some stats in terms of historically what has happened.
Yeah, you got it. Whenever Republican has been elected in the market, has gone up about 15.3%. Democrat was elected, not as good, 7.6%. But we take a look overall, it's about 11.28% return the year after a presidential election.
So hang tight for this year, and then you'll make about 11% next year, right?
You got it. But
now, of course, these are historical averages. So this means, there is no prescription for what will happen this year. But I think many times people are overly pessimistic that it's going to be the end of the world. And I always, will joke, I'm pretty sure Apple's not going to stop making iPhones, right? Because a Republican or a Democrat was elected president, right? They're going to figure out whatever the sentiment of the current political landscape is and do their best to make a profit during that time period.
You got it. So yeah, so historically the numbers are on our side there. Whenever it comes to a presidential election. So it's, we definitely, I wouldn't say you wouldn't experience any, volatility, but we're definitely seeing, some volatility already this year. But that is a good, a good headwind or tailwind that we have there that's going to kind of push us through here. So that's just one factor that we saw.
What are some optimistic or
factor.
positive? Yeah, what are some positive things you see coming?
So the other positive is the rates, the interest rates. So everybody saw this year the interest rates were climbing and climbing, and the Fed finally started talking a little bit more dovishly, or that they might actually start to pull back rates. So so that's going to help the economy. Anytime when money gets a little bit cheaper, or people can borrow money for a little bit less, it tends to help things out. So we're not, of course, analysts are being pretty conservative, so they're not seeing, we had such a huge increase there, of the rate increases. It's not going to drop the same way. So instead of going up, 3-4%, it's probably going to just pull back maybe about 1%. So right now that Wall Street, they do believe that the Fed is going to cut interest rates, but they still are, any time when the market is doing well and they're adding jobs, the Fed doesn't seem to want to cut interest rates. So we'll see. So that's one factor that should help the market is interest rates being cut. Another factor is that there is a record amount of money on the sidelines. So we saw in last year, there was actually over $1 trillion that were moved into money market funds. So I'm not saying maybe that they were sold off of the stock market or maybe they were in CDs or other assets, but we saw an inflow of over $1 trillion into money markets. So That's an easy decision to make whenever interest rates are up like this, but obviously that doesn't last, forever. So we see a lot of, a lot of cash on the sideline that is going to need somewhere to go. Especially whenever interest rates start to normalize again.
Yeah, Pete, I think we tend to see it with clients too. Last year was a time where it paid you to put money in savings. For a long time, you haven't earned anything to keep money in savings. So, that makes sense that a lot of that money stayed in money market accounts. I think with the positive appreciation of the S&P last year, if things tend to be on a good foot too, and interest rates are dropping slightly, people might reevaluate and start to put some of that money in, help carry the market along there a little bit more. I think one of the other things we had talked about, Pete, was just the supply chain, right? So ever since COVID, we've heard about the supply chain, right? There's a shortage of this, there's a shortage of this, that, and the other. And, I think one of the things that we had brought up is that it seems to be normalizing a little bit more now. So maybe some of those factors of being able to get a vehicle when you want one, or, even maybe more basic needs like eggs that also went crazy in price for a little bit due to a shortage. Hopefully some of that starts to ease a little bit more.
Absolutely. We're seeing some good things, not only are they, kind of normalizing, but we're finding that they're actually a lot more solid. The supply chains are a lot stronger.
Yeah. Yeah, I mean, I think that I think a lot of companies evaluated having multiple partners in their supply chain to help make it more stable over time. So hopefully now with those networks set up, it creates more stability in the future if we have international conflicts or disruptions in our supply chain overall.
Absolutely.
Yeah, I think one of the other things that Pete and I had talked about prior to jumping on, Wendy, was just, we need time when we're invested, right? We don't ever want to assume that all these positive factors we just went through, or we could certainly spend a whole podcast listing negative factors as well. We don't know what they're going to do. We need to be invested for a longer period of time. In general, it doesn't make sense to put the money you're going to take to the grocery store on Saturday in the stock market on Monday, right? We want to have that longer timeline. I mean, really, depending on your exact asset allocation, we're looking for 5 to 10 years if we're investing heavily in stocks to be getting that appreciation. If we look at a very, very short timeline, well, we could have anywhere from a 24 to 25% chance of losing money during a 1-year time period. So we want to stay away from that. I think for most folks that listen to the show that are nearing or in retirement, we want to make sure we're bucketing our money appropriately. If we think back to 2008, a lot of clients were very panicked in that time and would say, hey, I want to put all my money in cash. I'm going to wait it out a little bit, and then I'll reinvest when things calm down. And, Morningstar has this great chart that goes through the value of investing. And Pete, do you want to run through some of those figures that they have on that chart there?
Yeah, so 2008, you're like, I'm done with this. I'm putting the money in cash. Just give me whatever, I'm put it in the money market, put it in a CD. So if you had $100,000, today you would have $140,000. So, hey, made some money, right? Worth more than it was. And I guess you could be happy. And then you kind of take a look and say, well, what if I would have, actually moved it into cash for 1 year and then I went into the market? So if you held off just for 1 year in cash and then you went into the market, you said, fine, everything's going well again, I feel more comfortable. That $100,000 would have turned into $497,000. So still pretty good. Hey, you timed it a little bit, but you still had almost 500,000. So the third scenario here would be you didn't time the market. You stayed invested. You rode out the storm just like you probably had to do before. So that $100,000 would be worth $818,000 today. So that's just based on the S&P 500 versus cash. So $140,000 to $818,000.
Wendy, which
So
one do you choose? A, B, or C?
I'm going to take the one where I make the most money.
We'll
well,
call
that's
that
it.
A. We'll
That's
call that A.
right. That's right. And sometimes that's really tough to see. And we like to put things in perspective. So, whenever we have any doubt, we like to zoom out. So just, hey, you might have that might not look really good in the short term here, but what does it look like when we start taking that 30,000-foot view? What does it look like whenever we start, taking into, factors that are years and decades long instead of just months or years long?
Yeah. And, historically, the market always bounces back. So should we assume that
Um,
it will bounce back eventually?
like we talked about, there's analysts that say, pretty much it's up, down, or not moving at all. One of our analysts here at Morningstar, believes that the economy is going to start to return to a more boring and stable place. As things recovering from the pandemic and things normalizing. So that was his kind of his short take. And another analyst just said that, hey, there's a lot of noise out there. We understand there's a lot of uncertainty. Oh my, Josh, you're talking about war. You're talking about gas and oil. You're talking about elections. But it's still a good time to be invested. We still have good companies, that are stronger than ever. During this, as interest rates have climbed, companies that have survived, without needing free money, are actually stronger. They have much better fundamentals, and it's in a much better place to be. So like we said, yeah, it's still a good time to be invested.
Yeah, and I think, Wendy, a lot of it circles back to having a plan, right? If you know when you need that money, you can invest appropriately. Like I joked about going to the grocery store, we don't want to invest with the timeline of a week or less. That's certainly not healthy, but working with a planner, like we work with our clients to set up a structure to their plan to know when they're going to be tapping into that money can help them wait out those bad years in the market and also be making sure that they're taking advantage of the good years in the market.
Okay. Sounds good, guys. Any closing remarks?
Pete had pulled a Warren Buffett quote, and I'm just going to steal this right out of your mouth, Pete. So I'll just reel it in here. But it's a great one. So it's to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So we can help you with the framework and we can help you manage those emotions over time. That's our job as an advisor. Now, it's very easy to lose confidence when the market's down, right? That's a very natural reaction. If something's not working, we want to stop doing it, right? But what we know is that the appropriate framework can help us stay invested even in those troubling times.
Sounds good, guys. Okay. So, Josh, how can someone get in touch with you if they have some questions?
Yep. They can reach out to me by emailing me at jleonard@leonardadvisorygroup.com. They can email Pete at leonardadvisorygroup.com. They can give us a call at our office at 412-998-PLAN or check us out on our website at leonardadvisorygroup.com.
Okay. Well, thank you, guys. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.